MMTs, we're gathered here today with the Nasdaq Composite. We're gathered here to let you know that the 10-month moving average is coming into play on a monthly chart. MMTs, let me be very key specific, is that's the longer term view. The weekly is the midpoint, meaning so you got long term, so you got short term, medium, and long term. Short term is a daily, medium is a weekly, medium term trends are weekly, but the longer term trend, and we're overbought still. We're at 86%. For crying out loud, when I said we were going down, I never even seen these in the best rip-roaring bull economies, nor have I ever seen in the best economies with even low employment and U.S. citizens working in all economic indicators at their peak in prosperity and expansion prosperity. Have I ever seen a market? And this happened in the 1930s from the systemic 1929 lows. The same kind of behavior, as I've said in all of these analyses over the last couple of years, that we would have a tsunami rally. And we have. And the thing about it is that these, on a monthly longer term, that the Nasdaq comp remains overbought. If we sell through that 10-month moving average, it's still bullish now because it's rising. It takes longer for the monthly moving average to make a turn. What you're going to know, MMT, if we break below and start to sell through it, we're going to come down. And the 20-month moving average in a long term comes into play right here. Right about slightly above 25, or right around 2,500. This is the breakout rally, but what we're missing here is that you don't have the big rally monthly bars up here at this top like you did over here when in 2010 we started that rally, that 4-month rally, and we got, overbought here, and then we consolidated it and we broke higher, and that's what bull rallies do. And one thing I'm going to make very clear here, I'm going to draw a horizontal trend line right there at the high. And you go back and look, right here is a 2007 reversal. What they have done on a monthly level is they've come up and kissed it goodbye right now. And this was where the original reversal and systemic risk had occurred. We are pretty much out of that systemic risk right now. The real risk is regulatory reviews and regulatory government and regulatory restrictions. That's holding back economic prosperity. They're not doing the right thing. They can't compete with the rest of the world until we as a nation get lower and start helping the U.S. consumer. The U.S. consumer has been beaten worse than being beat, and been beaten down and deleveraged down, and I don't like it. I never have liked these kinds of events, and I don't like how people get treated in these markets. But a lot of people don't listen. They're consumed by greed, they're consumed by exuberance, they're consumed by lots of things, my friends, my MMTs. And what I am saying is that the kiss goodbye came right up here to this trend line, right where that major reversal happened. Now, granted that the systemic risk is not in play right now. However, over a period of time, with gross domestic product coming down, earnings, sales, book to sales ratio, and inventories, and seasonality is that the consumer with high oil and all these other things can bring this Nasdaq all the way back down here. This was where the lower end of the breakout was, at this trend line right there. And that the monthly rising moving averages are bullish, my friends. But what you're going to learn here is on a monthly level, longer term, you're still overbought. Now, having said that, if you start to sell through that blue line, that's that 10-month moving average right there. Sellers will start to unload. Stop market orders will get triggered, and down you go. And coming back over here across the double top breakout, that's this handle right there. This is what we call a double top. There was that reversal in 2010. There was that top reversal. You came up. You got through it late in 2010 right here. And then 2011, everybody had it hunky-dory. Look, last time we had the dips, they were viable to that top. They came in. Here, and today is only the 8th. And if we sell through it, you're going to get more selling in the Nasdaq from that longer term view. Still overbought. Now, on the weekly chart, right here on the Nasdaq comp here is the neckline that we talk about from the last correction of 2011. We shorted that down. It didn't want to go. It held that area. And once again, you get into this little weekly double top right here. And we busted up through it. We came down, we tested that, and then we made the all-time blow-off high right there. That's where we called the all-time reversal. Now, the difference between the rally, my friends, MMTs, on the Nasdaq comp is that the bull rally was putting it up here in 2010, and you had all your weekly moving averages going the right way, which is a mid-term. It's medium. It's not the longer view, it's a medium view. We'll get to the daily, which is a short-term view, but let me tell you something major has happened, MMTs. If that 10-week crosses over the 20-week and you close 4 weeks below it, that is a bear qualifier. The SMF bear qualifier. Now, we have all the analysis that proves that we're 100% right. It would be good for people to listen to me. The upside on the on this Nasdaq comp is going to be a neckline in price volatility, short-term. So basically, the lower end of that is going to be your resistance. Then you're going to go to the lower end of that right into the moving averages, which is the upper side volatility. Now, we have a 50-week moving average that is in play here, right around 2561. If we break that bottom, we're going to test that. But let me caution my new MMT enrollees is what the SMF bear qualifier is versus when people were being taught what the bull qualifier was. 4 weeks above the moving averages, closing. Got to close 4 weeks below it. And that when you get into a bear qualifier, it takes a long time for the market to get back into that bull qualifier. And that the upside resistance in equities, and we stay range bound until the end of the year, because if we do get a couple of more weeks, if it does do it, then it's called bear qualifier. And bear qualifiers are different than bull qualifiers. Now, having said all of that, that's the damage. That's that neckline right here. Double top breakout over here at the end of 2010 with the beginning first correction of the year to the blow off top, and this reversal is longer in tooth than the first reversal, and that's how they should be. Now, having said that, the moving average convergence divergence has been declining, and the jeopardy of the whole trend is when they happen that way. Now, on the other hand, let's go to a daily chart, and let's take a look at the daily chart, MMTs. Here we are on the daily, and we've had 1, 2, 3, 4, 5, 6 days down. Now, standard traditional thing is that trends change. If I have 5 consecutive up days, that's a change to a bull. That's that old myth and that old standard, okay? But now if I have 5 consecutive down days, that means that that bull is getting weaker, and you start looking where bear trends start to set up. From the bull rally, that is, MMTs, you're going to learn that this bottom down here is going to be your next support level, and that the 200-day simple moving average is coming in play. Now, MMTs, let's take a look. We are not overbought on the daily. We are short-term oversold. We're short-term upside volatility rallies can happen with short covering and people coming in and buying dips, because you're not overbought on the daily. So in the shorter 5-day macro part of this trend, we're oversold, where stocks can bounce off of their support levels, because we can also see that 7.80 is quite different. When I called the reversal here, we were on a daily level, 91.99. Sorry, bye-bye, kiss goodbye, kiss goodbye. Now, in a shorter time macro frame of 5 trading days, 7 trading days, 10 trading days, is we're sitting up for a reversal. Okay? Now, one of the things that can happen still is that we test that and then we reverse. Why would this be a favorable bounce here? Because you're extremely overbought in the short term. You are not overbought, you are short-term oversold in that neighborhood now. You're in the neighborhood of oversold in a short term, where stocks can bounce in their counter trends and price volatility, overbought, oversold, short term, medium term, long term. And my friends, if we break this major level tomorrow, that trend line, and start to sell down, we could rapidly go down even intraday and hit that, and then have a big rally off the bottom, and or sell through there. So you got to know where we're at. You're going to be taught this with the trade management intraday about how equities trade intraday and why equities are getting a haircut. And equities were overbought, extremely overbought on an individual basis and individual names that we cover and trade on a daily basis. So what will end up happening to the bear, MMT, is that the bear in the short term, short seller bear in the short term, he doesn't know when to come out, just like the exuberant bull up here doesn't know when to come out. They both don't. They're both equal in their behavior pattern with the tape, MMTs. This is the Nasdaq Comp. This is the analysis moving forward. This is June 8th of 2011 at 2:16 p.m. Pacific Standard Time. Now, we're set up, but I will say exuberance, bear pessimisticness can have the same type of behavior as irrational exuberance does. You can stay oversold for a period of time just like you can overbought. But let me tell you something. The daily moving averages are going the wrong way. They're not going up. It's all short-term stuff. The weekly is the key, and the monthly longer term says that the Nasdaq remains overbought in the bull rally. Short-term oversold. Short-term oversold.